In this video, we're going to talk about picking the right underlying. So let's jump into it. So when we're talking about underlyings, what we're really talking about is what security are we trading options on? So what I personally use are index funds rather than individual stocks. The reason why I use index funds, it's because you get instant diversification. I'm bullish on them in the long term, and it basically helps me sleep at night. So if you're not familiar with index funds, basically what they are is, think of it like a circle, and let's use the S&P 500 as an example of an index fund. So when you invest money into an index fund, you basically get access to this pie of just a bunch of different companies. And so if you, let's say, invest $100, you will get diversification into 500 of the largest publicly traded companies in the US. So that means this $100 will never go to zero, because that means all 500 of these companies would have went to zero. At which point we probably have bigger things to worry about than money, right? If every single company in the US went to zero, that's going to be a big issue. So with S&P 500, yeah, there is short-term risk, as in it does dip, but it means you just own the 500 of the largest companies in the US, and so it will most likely never go to zero. And this is why I personally love trading SPY. Another ticker I like using is QQQ. This is similar to the S&P 500, except this is all NASDAQ companies. So NASDAQ, about half of it is mostly tech companies, and so this has a lot more tech leaning, but these are also the larger companies such as Amazon, Google, Facebook, so companies that I'm still bullish on in the long run. And because these are all concentrated in the tech space, there's a little bit more risk, so it is actually a little bit more volatile. But if you remember one of the Greeks that we talked about, volatility is actually your friend. The more volatile something is, the higher the vega is, which means the option prices are more expensive, which means as option sellers, we get to collect a larger premium. But just because it is volatile does not mean we should be trading it. QQQ is good enough, in my opinion, for high volatility and lower risk, just because it is diversified, has about 100 companies in there. S&P 500, as the name says, has 500 companies. And the last one, which I personally trade, is known as IWM. This is the Russell 2000 index. So this is a small cap index. Similarly, if you invest $100 into this, you'll get exposure into 2,000 of the smallest companies in the US. So this is actually more volatile than the S&P 500 because S&P is more large cap. So these are companies that already have an established track record and are just usually less volatile. As for IWM, these companies are pretty much newer. Even though they are publicly traded, they're still very small, but you are exposed to 2,000 of these companies. So it's relatively quote unquote safe. It most likely will not go to zero, but just remember this is more volatile. So I personally use these three tickers and I like them personally. I mean, there's a lot of volatility in the short term, but remember, if you're holding these for long term, and I think it does produce a good opportunity to generate income consistently and safely, just because these are underlyings that you want to own. Now let's talk about why I don't recommend individual stocks. Well, the main reason is that there's no diversification. Basically, if there's fraud, the company's stock is basically going to go down. And so there is very high risk, because if you invest $100 into this, this can go to zero. And there's really nothing you can do about it using this strategy. Because remember, the strategies which are in this course are meant for bullish investors, long-term buy and hold investors, just with an additional yield. So no amount of selling calls or puts is going to save you from the stock going from 100 to zero. Yeah, you may make some premium and you may collect maybe $20, but you're still taking an $80 loss. So yes, you are outperforming someone who had just bought and held it while it went to zero, but I think that's still too much risk. And so I personally try to stay away from individual stocks. However, if you are still bullish on individual stocks, I'm not going to stop you. I think that could still be profitable as long as you pick the right underlying. Everything is based on picking the right underlying. So let's take a look at what we should actually use for the underlying if we're not going to do index funds. Again, I recommend index funds, but here's a great resource in case you don't want to do index funds. Go to this website called finviz.com, and then at the top, there's something that says screener. And then here you could actually create a filter. So market cap, I personally like doing mega over 200 billion, because this way These companies have track records and they're most likely not going to go to zero. But again, there is always that risk. They are over levered or something happens and it technically can go to zero. As for index funds, again, it's very unlikely they will go to zero because that means all 500 companies in the S&P 500 would have had to go to zero. But again, if you're doing individual stocks, you would come here, click mega, and you could actually filter through however you'd like, but this is what I personally use. And then if you want to sort by specific sectors, you could do that as well. And then right here, you make sure you click optionable, and then country. I usually do US because I only trade in the US, but based on where you're at, or if you want exposure in different countries, you can do that as well. Right here, you can see all the companies that fit that criteria. And then I come to the price, I click price, and then you can see everything that meets this criteria and what the prices are trading at. Based on how much capital you have available, you could see which stocks would be a good fit for your option strategies. So for example, Bank of America at the time of this recording is trading at around $30. So for each contract, you need about $3,000 in collateral to sell one put option. So if you have $10,000, you could do about 3 contracts of Bank of America. But again, that means your entire portfolio is allocated just to Bank of America. And so it's not something I'd necessarily recommend, but it is something you can do. Same thing here. You could get some Verizon or Pfizer, some Coca-Cola. So you could go up to maybe even Amazon. They just had a stock split recently, so that's pretty good. So that means if you have $10,000 or slightly more, you can sell one contract and have exposure to Amazon. Based on what you're trying to do, again, there are a lot of companies and just looking at all this, I wouldn't really recommend trading any of these individual companies unless you have a lot of money, because each one of these contracts you need $32,000, $46,000 for. So at this point, might as well just do index funds and get that diversification properly. Again, so just a quick recap, I personally only trade index funds because I don't want to pick individual stocks. That's, I think, too much risk for me and just not where my expertise is. And so I let the market do what it's going to do. I just know I'm going to outperform someone during bear markets through these strategies, and during bull markets, I'm going to be generating consistent income. So I have that safety and I know that I can sleep well at night instead of wondering, oh my gosh, this company's financials are coming out next week and maybe they're going to miss earnings or something's going to happen, and that's just not necessarily what I do. But again, you do whatever you want. I think FinViz is a great resource, even if you don't want to trade the specific strategy, but if you're just looking at learning about how to invest in individual stocks or looking for a screener, I think it's a great resource. Awesome. I'll see you guys in the next video.